All right, you are on the webinar. This is Gary Schnitkey. Bruce Sherrick here is with me, and Luke Worrell is also with us. We're going to present an outlook for farmland prices and rents, and that's going to give results from the Illinois Society of Professional Farm Managers and Rural Appraisers survey. So that's what this is going to be about. We have one question to begin it, though. This is what we're going to ask you what you think, and then we're going to report what we think. So if you would launch the poll, Jim. If you wouldn't mind answering this question, what do you think farmland prices will do in the last half of 2020? That's a question that we asked every year. So we'll get the audience feel for what they think is going to happen. Bruce has his opinions, but he's not going to say his opinions until his turn, right?
And then I've learned a long time ago, the best thing to do is to agree with the poll results, right?
Oh, there you go.
Oh, wait, no, I'm not trying to get elected.
No, you don't have to get elected here. And again, we'll answer this question or what our survey results did. This year, we also took a little bit of addition to that, looked 5 years down the road. Jim's going to show the results now of our survey. 6% of you think it's going to decrease by 3%. 18% think decrease by less than 3%. 64% stay the same. 9% increase, less than 3%, and 2% think increase more than 2%. Those are the results of our poll. Again, we are going to give you the Illinois Society members feel for that. That will be our first topic, expectations for 2020 farmland prices and 21 cash rents. We'll then go 5 years from now, talk a bit about leasing arrangements, and then Bruce will end up with a little bit more about farmland prices. So that's our outline. And we're going to start here with expectations for 2020 farmland prices and 21 cash rents. That's the Illinois Society survey. And Luke, tell us about it.
All right. Well, hey, thank you. I want to thank everybody for taking the time. Obviously, this isn't our first choice. We would much rather be in person in Iowa doing this, but it's 2020, so we're doing what we have to do. Hopefully, we can do this next year in person. And I certainly would be looking forward to that. So my section here is going to be, as this slide shows, expectations kind of for 2020 farmland prices, the rest of the year, kind of what we've seen so far, and then moving into some cash rent expectations for 2021. So moving on, obviously this can't happen without the good people, not only the U of I, but also the members and the people involved with the Illinois Society of Professional Farm Managers and Rural Appraisers. So about 350 members and friends strong, and it's been going on for, before you know it, 100 years. So we'd love to. I will give you a quick plug here, real quick. Subject to change, of course, but we are hoping to have our Land Values Conference in person in March. So right now that's scheduled for Thursday, March 18th. So it's never too early to throw that on your calendar. Thursday, March 18th. We hope to see you in person next year. So quick recap moving forward. Oh, actually, real quick here, if you want to see, and I think Gary mentioned this, if you want to see the 2020 Farmland Values and Lease Trends Report, it can be downloaded there at the website that's on your screen. So feel free to do that. And that's always a great resource that we like to have on hand and make sure others that we do business with have. So moving forward, if you are chiming in and you aren't familiar with kind of how we break land into classifications, this is kind of your cheat sheet here. When we take responses, we look at excellent productivity of PI ratings, 133 and above, and good productivity 132 down to 117, and then average productivity 116 to 100. And so for this purposes here today, we're going to mainly focus there on those top three categories, but certainly when the complete year-end synopsis comes out next March, we're going to touch base on all these classifications. So that's just that's just a quick refresher. So we'll go ahead and move forward and get into the meat of this here. I think it is 2020, so I think everybody is almost kind of expects craziness, but you're going to see that really, a lot of the numbers we saw maybe not be quite as volatile as one would have thought, 5-6 months ago. And a lot of the data kind of looks a lot like the data from the end of 2019. So when it comes to excellent quality farmland, things honestly have continued to firm up. I know a lot of regions saw some improvement last year, and so far during the first half of this year, we've seen the same. Region 1 kind of led the charge there, as you can see, with a 3% jump, but nearly everybody was at least steady. Obviously, Region 6 there had a very minimal reduction, but everybody else kind of is holding firm. You can see Region 7, my home region there, it had the highest number heading into the year, and it has remained unchanged, even in the midst of the craziness we are living through right now. Should also be mentioned that if we didn't have enough subsequent data to feel we could give a really accurate portrayal of how things are going, those sections are blank. So we're not intentionally trying to pick on regions 8, 9, and 10 here. We just didn't have enough responses to feel good about what numbers to put in there. So, Class A acreage over the last several years has kind of carried the flag, carried the torch for values, and we're continuing to see that, here through the first half of 2020. Moving on to, Class B, or good quality farmland, you see a little more variance here. Obviously Region 5 saw a nice jump, that eastern Illinois region, Champaign, Danville area, and everybody else, was pretty, in the same ballpark. We see some up 2%, some down 2%, but not a ton of fluctuation there. If you take out Region 5, almost everybody kind of moved through a similar window. So not a little more variance there than we saw in Class A, but that really isn't surprising, as you kind of can start to see different fluctuations even within specific regions. And even, to be honestly, even if you did a county by county breakdown, you would see some very precise, specific geography come into play here. So not overly surprised that we're getting a little more variance as we kind of start to move away from Class A acreage. Moving on to Class C, as we call it, or average quality. Pretty much, everybody was kind of right there. As you can see, nobody moved up or down more than 2%. Pretty steady. All movement was around 1%, either negative or positive. And in here, when you see average quality, one thing to consider is, as I call them, combo farms, or some farms that might have some recreational acreage or non-tillable acreage. Farms that have a waterway or two through them, some drainage complexities, things like that start to pop up here in this category. So, I would imagine, not to sound like a broken record, but precise area, location, you're going to see a lot of, even though these numbers aren't drastic, positive or negatively, you start looking to these regions and into these specific counties, and you're probably going to see some hot spots there. One thing I think we have seen just in these numbers, and even though it's not drastic, and I think we have seen this for a couple of years perhaps, is that the gap is kind of continuing to, I would say, slowly widen between the Class A values and the Class B and C for a number of reasons. But, I think we've seen that for the last handful of years, that the Class A acreage has, even when we were seeing some moderate to slow declines from, 16 through 18, Class A acreage seemed to withstand some of that pressure better than other classifications of land. And, we're seeing that gap widen out just a bit. So that kind of leads us to another question of who is buying and who is selling. And again, I want to go back, and obviously we skipped over recreational land and below average, but again, that's just the number of the amount of data that had a role on that. But let's look at these here, and I guess I would classify these two pie charts as me personally, I would say kind of unsurprising. Farmers and individual investors, what we would consider probably local money, incorporate for around 80% of those people who are buying land. And non-local investors are at 11%, and institutional investors around 8%. So, I think a lot of times, the big investment funds or a foreign buyer or a big conglomerate, a lot of times they get the headlines, and those are big flashy deals, but the vast majority of transactions continue to be owner operators in what would be considered what I would consider local money. And again, this likely can vary from region to region. I imagine certain regions with large tracts, high quality tracts, probably see more interest from the large scale institutional investors than other parts of the state. So it'd be interesting to see how that would break down if we could, just by region or even by county. That would be really captivating. So moving on to the sellers, or if we go back one time, there you go, thanks. Moving on to the sellers of farmland, the biggest seller, unsurprisingly, is the estate and post-estate settlements. And being in the land business, the simple fact is that what has been called the greatest generation is aging and passing away, and a lot of times then those land holdings are passed on to sibling sets, or and a lot of times you get some interesting situations there that can lead to a sale. And so I don't see that changing. To me, that's not surprising that's a majority of what we see leading to the selling of land. Farmers, interestingly enough, 17% of farms that have sold are farmers, and I imagine that probably is for a number of different reasons, whether it's lessening their debt load, or kind of readjusting their holdings, or trying to, sell a couple rough 80s for a really nice 100. And potentially, you would assume that there could be some financial duress, at play in certain instances as well. So the other three sectors there: institutional investors 5%, local investors 8%, and non-local 8%. They're kind of all equal, but the big two catalysts there. The big one is just the settling of estates, and then farmers, for one reason or another, selling land. So we'll move on to the expectations of what we saw. And the good news here is that apparently nobody sees a cliff. That was in a year where we could use some good news. That was good. No one said they saw a decrease more than 3% for the remainder of the year, at least for those who participated in this poll. I know before we got started here, that was a different case. But, like our poll here this morning, a majority thinks we're going to kind of just stay the course, stay the same. And 28% thinks we'll see a decrease less than 3%, with 12% thinking that we'll see an increase less than 3%. So, when it comes down to it, what the respondents think is the second half of the year is going to look a lot like the first. Some mild fluctuations, between 3% to the positive and 3% to the negative, but probably averaging out, and we're going to kind of stay the course here through the last little bit of the year. So we'll move on to cash rent projections here. The survey shows an expected decrease on excellent quality land, around 2.5%, and on lower quality land, 5% decline. This will likely vary substantially from region to region. And again, I know I'm being repetitive, but I feel like the last several years we've seen it hold truer than ever, that precise geography. I mean, even within my own home county here of Morgan, there are parts of Morgan that are uber competitive. And I'm not seeing any declines there, but that's not to say different parts of the county aren't. So this is just as a whole, but your specific area is likely going to see different variations of these findings. And it's going to be incredibly interesting to see the regional breakdown of these types of questions come next March at our event, when we can kind of peel back a few more layers and really see where we're at. But obviously it is interesting times for growers, and so I'm not surprised that we are seeing some mild declines in expectations of rent. But I would, at least here in my area, I'm thinking we'll probably be more steady than down. Another big thing that's been obviously been a hot topic in the last several years, moving on to the next slide, is federal aid. So before we chime in and continue this, we have another poll here, I believe, to get our participants' take on this. And so let us know what you think. Expectations for federal aid here, the rest of the way here in 2020.
So, yep. So we don't know what this is, obviously. So you tell us, and we'll parrot it back to you, and we'll tell you what our Illinois Society members thought here in a minute. And this is, you now have 64% of the vote. And close the poll, Jim. And here's what you said. 7% of you thought over 75%. $75 per acre, 23% between 50 and 75. Half of you, roughly half of you thought between 25 and 50. 15% thought less than 25, and 6% said nothing. So here's what the survey said.
Yeah,
here.
go ahead. Go ahead, Gary.
No, go ahead, Jim. Luke, you take this one. So.
Gotcha. So yeah, a little bit different of a take this morning as opposed to what came through, but I think 85% of participants expected something else here in 2020, with the majority thinking that it would be less than $25 per acre, and 15% actually didn't think there would be anything. But yes, as you can see, 56% thought it would be less than $25 an acre, and 29% thought it would be 25 to 50. And nobody really, at least who responded on this first survey, expected any major program package of anything over $50 an acre. Looking forward to 2021, that is, we can all hope for some smoother sailings, hopefully, fingers crossed. And so hopefully with some stability, we won't see the need for any further federal aid, with 55% of folks responding not expecting any type of payment in 2021. And those who do think we might see a payment continue to not see a large-scale program. 31% of those expecting something in 2021 think it will be less than $25 per acre, and 14% thinking that if we do see something, it could be $25 to $50 an acre. So some interesting findings, and of course, hey, everything's subject to change here in 2020. Kind of closing out my portion here. Obviously, the year has been nuts and quite crazy. And it probably has felt like a roller coaster, but really the numbers are fairly steady, all things considered, and especially when you look at some of the other sectors of the economy. So, most of the fluctuations we just reviewed were all within 3% to the negative or positive. So, in a world where we expect volatility, we aren't seeing a ton of it right now, at least with the data we've gone over here today. But hey, 2020 still has time to do 2020 things, and there's a large crop in the field more than likely, and we'll see how the rest of the year plays out. But I appreciate everyone who took the time to send in information. Obviously, the more respondents we get, the better, more firm data we can give to you here today. So a big thanks again to those joining us and to those who submitted information. So, Gary, I think that's my little first bit here, and I'll turn it back over to you.
Yeah, thank you, Luke. And again, thank the members of the Illinois Society for completing the survey. This slide, by the way, was meant to represent MFP and CFAP payments or whatever the next ad hoc round is. It wasn't particularly meant to represent ARC and PLC. All right. What was the average federal aid to date in 2020? So that would primarily be CFAP payments, and we would put that at roughly $25 per acre. That actually relates to the 2019 crop because it was related to unsold inventory on the 2019 crop. Looking now, 5 years from now, we asked our Illinois Society to give us a longer run or an intermediate run view, and we'll start with the same question that we asked you. Ask them, give us your feel. Well, now we're not looking at next year, but 5 years from now, and sometimes it's interesting to step back a little bit. We get involved with all of the events of the day. What do we think it's going to look like 5 years from now? And give us a feel here, and then we will tell you what our Illinois Society members said. Again, we're looking 5 years out, which seems like a lifetime, but it will go by in an instant, right? Hopefully we
Indeed.
won't. Hopefully we will not be doing social distancing 5 years from now. So we're almost done. You're keeping voting here, or we're done now. What is our vote? Vote here. We're still sharing the results here. Here's what you said. 7% said stay the same. 67% said increase 1 to 10%, and 8% increase more than 10%. And 18% thought it would go down, with only 1% thinking it would go down 10% or more. So overall, you guys thought, or our people here today thought it would be stay the same or increase. And actually, if you look at the results of our poll of the Illinois Society members, it was largely the same as the poll of the poll of we had today. 14% said stay the same, 55% said higher. By the way, we're looking 5 years from now, and that's actually a fairly small growth rate on a yearly basis. So we're even the higher 1 to 10% is sort of a stable look at things. 10% thought lower, and nobody thought we would go down 10%. So our respondents on either side on this poll, except 3%, are largely thinking that we don't have a problem, I guess, with farmland prices. Bruce is napping at the nip here, but I think he would agree with that.
I do.
So looking forward, cash rents 5 years from now, what do we expect to see there? About the same, which is centering this is about 23%, and we saw and 35% think will be 1 to 10% higher, 35%, and then you can see 7% thought higher than 10%. Lower, we had 26% of you thought lower by 1 to 10%, 9% thought 10 to 20%, and none in our survey thought it would be over 20%. Overall, again, what I would interpret this as saying, particularly about the same and higher, 1 to 10%, that's really a pretty small growth rate. So we're looking, according to this survey results, at a stable situation. So everybody is sort of not expecting huge declines or a stable land market with good current returns in the terms of cash rents, but likely very few dividend or very few capital gains over the next 10 years. We asked our survey members what they expected for 2020 or prices in 2022. Soybean price was $9.09, which actually, if you're looking at cash prices now, is a little bit lower than what it is out there right now. but it's well above what WASD is projecting, or the USDA is projecting for 2020 sales. Expected corn price $3.77, roughly equal to what it was for the last several years, but lower. That $3.77 would be higher than what we would expect for 2020 crop. Most of our respondents are expecting low amounts of inflation and at most modest increases in interest rates. So our respondents believe that the monetary policy is going to be loose, but not inflation producing, and not really increasing our interest rates either. Bruce is
Just thinking if the response from Jay Powell on the 27th of August this month would have affected the survey at all, and just having an announcement of expectations for empirical targets for inflation going forward.
That, by the way, our survey was done before that announcement, so that doesn't even filter in here. Just to go over quickly, leasing arrangements, we're going to cover some of the leasing arrangement results from our survey. We got a question of how much of farmland is leased in Illinois. About 50% of the farmland in Illinois is released. We happen to be, or leased, rented. We happen to be one of the higher states in that area. And if you look at our larger farm operations, those owned percents go down. You can see that on our tenure on grain farms, this is from FBFM, northern, central, and southern Illinois, right at 20% of the land is owned, a little bit, actually less than that, northern and central Illinois. How FBFM, if we look at what FBFM is doing there, about share rent leases are about 21% in northern Illinois, 42% in central, and 36% in southern. That's a pretty similar trend that we usually see. Northern Illinois has less share rents than the remainder of the state, and over time, central and southern Illinois has been shifting from share rent to cash rent. Cash rent 60%, northern and central and southern Illinois 44%. So those are the percentage. Just again, to give some leasing basics here, and if you have a professional farm manager, this will always happen. Written leased is the best. Though some non-professionally farm leases are not written, which is not that good of a practice. If we don't have a written lease, we have till October 31 to terminate the lease. And most of our leases in the survey, as well as outside the survey, are year-to-year leases. They represent the vast majority of leases, and there are some leases that are 2 or 3 years in length. That really hasn't changed much in recent years, and we again see most of those leases being year to year. And again, the uncertainty in the agricultural market largely dictates that those leases are roughly year to year. In our survey, and this is from the Illinois Society survey, 42% of the land that Illinois Society members manage, 42% are in cash rents, 23% are share rents. You'll notice there that there's a share rent with modification down there. Share rents in northern and central Illinois, the percentage of the share typically is 50-50, but there's often a modification to the share rent. The most prevalent type of modification is a supplemental or privileged rent associated with those leases, and those in our survey, Illinois Society survey, run about $25 per acre. 19% of the leases of Illinois Society professionally managed land is variable cash rent. That happens to be a higher percentage than non-professionally managed leases, and custom farming makes about 6% of those, the remaining leases. You see the definitions of what those lease types mean there. Again, covering those in share rent arrangements, and there's often a supplemental rent of $20 to $30 per acre, and farmers bear all the labor and machinery expenses on most of those leases. We recently had a release of the Illinois county rents for 2020. You see those listed on the map to the right. There wasn't a lot of change from 2019. You'll see some areas where the change is larger. That happened primarily in northern Illinois, but this will give you a feel for what the National Ag Statistics Service is saying rents look like, and you see the 2020 listed there to the right. Variable cash leases, survey response would say that typically a rent factor from our Illinois survey is 33% for corn, 40% for soybeans, and that would be of gross revenue. The most typical type is yields is based on the farm, and prices are based on an average of something, Wednesday from an agreed spot from spring to fall. Some of the leases base those on future prices as well, and all of those have some sort of variable cash rent. Leases, typically, farmland leases, there are maintenance costs such as structural maintenance and waterways. Often the farmer will maintain those leases, but the cost of those, if there are a cost, will be borne by the landowner. It depends a bit about whether the land cost is maintenance or some improvement. And improvements would generally be the responsibility of the landowner, maintenance more so the farmer. Here we give an example of what that lease might look like, and you can look at that and study that more on the handout. Farmland prices. Bruce, take it away.
Yeah, not a whole lot of additional things to say, except put a little bit of this into a national context, and then talk a little bit about what we think some of the factors are that are leading to, as Luke correctly pointed out, more stability than you might get as a guess if you ask the person walking down the street. I think the narrative about the decreased farm income and the lower crop prices and the impact of trade stress would make most folks think that farm income would be substantially down, and therefore you would have a natural following of the prices of the assets generating them, but it's simply not been the case. And this is just to expand out from our, I-state centrism to some extent, and to look at Illinois up on average, a little over 1.5%, Iowa down about the same amount that we were up, Indiana almost stabled out, Ohio 1. But the real story is, if you look everywhere, we don't have any major areas of major decline. That's good news. USDA recently updated their expectation for farm income to just over $100 billion for the year as well. Again, reflecting all the things that have happened in 2020. We still have low commodity prices, but we had various and different forms of supplemental assistance. Excuse me, crop insurance seems to always do what it should do. And despite the devastating winds and some of the weather problems in Iowa, it looks to me like it's at least going to be a fairly predictable underpinning as well. So again, not to point out anything specific, because I don't think averages necessarily are the easiest thing to look at and say what happened to the value of my farm, but to kind of eliminate the possibility of the sky is falling style story, at least. And maybe let's go to the next slide too. This is part of a presentation that we make a lot and often in many different contexts. But one of the other things to remember is that the cost of owning income in the future. A way to think about it is, how much would you pay to have a dollar bill delivered to your mailbox every single year for the foreseeable future? Well, it depends how much it costs to capture that, and the discount rate we often use is something related to treasury rates. So again, just remembering two stories here: the interest rates, or the cost of capital, is substantially lower than it's ever been in the past, or at least since the 80s. Been a steady decline in the real cost of owning farmland. And this is something important to remember, because you're always comparing that to the value of other investments one could make. And the equity markets, until 2 days ago or yesterday and today, things can only go up, right? Well, now we have, again, evidence that that's not always true. And so farmland as an investment, in addition to farmland as an income generator, has continued, again, almost entirely through my career, to become more possible to look at as a place to store income, or a place to store money. And so the demand for farmland is also highly supportive right now. A couple of weeks ago, we did a related webinar, and I pointed out then that the number of external inquiries that I've received, and I'm sure Luke probably has had the same experience, and the folks that are really in the real world market back me up on this. It's been a shockingly high number of inquiries, and they're coming from places that were not where we used to get them. Did mention, almost in passing and sort of as a quip, the stated reorientation that the Federal Open Market Committee made just barely a week ago, and had a funny translation. I won't attribute this to the source in particular in case it's me, but the translation of Powell's speech, which could have been, we printed a whole bunch of money, and seems like recovery is going a little quicker than we expected, so there could be some pressure on inflation, and we'll move to a more empirical version of our target. And so the natural question is, if we do that, what will happen to farmland values? If we have higher cap rates, if we have higher cost of money, does that in fact reverse this trend we've been seeing for a really long time? And I just want to point out that there's way more to the story than that, because the definition of inflation, of course, is the nominal change in price of widely consumed products and goods. And that's exactly what farmland creates. Farmland creates commodities that are widely consumed, and historically, farmland has been positively correlated with inflation, no matter what time period you look at, how you measure it, and with a bit of a lag, admittedly. But it's probably a good story for farmland, and it's at least a good story for farmland relative to other real estate that has depreciable features if we have a controlled re-entry into a normal yield curve environment. The other things to remember, farmland is still traded in very thin markets. We don't have a whole lot of transactions to look at. We can't say, look at the value of the 50% of the farmland that turned over, because about 1 to 1.5% turns over at arm's length. We retitle either within family, to trust, for other reasons, a bigger share than that. But to get an estimate of the fraction that actually trades, it's a little harder to think about that. Looking at the I states in more specific terms, the USDA data confirm, I guess, what the Illinois data and society said, and again, just broadening that out across the 3 I states. Iowa has always been a bit more volatile than Illinois. Not sure that I fully understand why. Possible explanations are the anti-corporate farming law, smaller holdings in certain parts of the state. The southern half of Iowa is very much like the southern part of Illinois, northern part very much like northern Illinois, but just a little different lease structure as well. But again, nothing very startling here. This is a good moment though to pause and reiterate what Luke said too. The Illinois Society does a massive and very impressive project every year that differs in a material way from almost any other source of information, in that the membership, the actual folks working in the industry, screen every transaction and comment on whether or not this is a realistic transaction, or whether it was influenced by development pressure, or a neighbor that was fighting with another neighbor, or was in a particularly difficult market, and provide the commentary around the sales that help us condition and have a lot of confidence that the information we get out of that actually reflects the practice and performance from the perspective of real farm managers and real landowners. So last slide that I'll talk about, just again, if we were to eliminate farmers and look at the investors' response instead, and this is the flip side of the same coin. NACREIF, we do a quarterly presentation from NACREIF on all of the territories and all of the forms of farmland and ownership, so permanent crops, annual crops. They're subdivided by management type as well. But how have the investors done? And it turns out that the investors have done about what we think. I mean, the numbers bear out what we get from survey results as well, and that the last year, the total return in the Corn Belt to institutionally owned land was also pressing about 4%. And I like this number, and I like it up on the screen in front of people, because one of the questions I like to ask is, did you think 3% was a high or a low number 3 years ago? And when cap rates in farmland were falling and rents were going up and asset values weren't going down, did you think 3% was a high or low number? And the institutional investors might have said, it's kind of a low number, but it's a super safe asset, negatively correlated with our equity positions, gives us positive exposure to long-term inflation. So yeah, it's still a desirable thing. And my point is that farmland, for that perspective, remains a reasonably positive, highly demanded product as well. That's all I wanted to say about farmland values. And Gary, I see that we have quite a bit of question kind of roll through going through. You want to address some of those?
Yeah, and if we would like to thank our FarmDoc sponsors, including TIAA Craft and Compier and Farm Credit Illinois, as well as Illinois Corn Growers and Growmark. Those are important sources of our support for FarmDoc. Again, if you have any questions that you would like to ask of Luke in particular or Bruce in particular, you can go ahead and ask them. Please type them in and we will take them as we go. So one of the questions is, it doesn't seem to me that a variable cash rent with a 200 base rent you described would punch out as high as a fixed cash rents of almost $300 per acre, and you are absolutely correct. It would not pencil out to be the same return as approximately a $300 cash rent. Having said that, I would suggest that you also include the CFAP and MFP payments in that variable rate calculation, because they are part of the revenue. They weren't often may have not been specifically mentioned in the lease in previous years, but given the frequency that they are occurring, you might want to put those in the lease terms, and that would get you closer to $300 per acre. So variable cash rents, I would suggest putting in the MFP and CFAP payments. So here's the next question. Do you predict any future impacts on farmland prices on Illinois to the new and growing opportunities to buy shares in farm and farmland anywhere in the U.S. or other countries?
So I think this is probably referring to some of the online and ag tech ventures. I can think of 7 actually that have the ability, like Acre Trader or Farm Together or Farm Funder without the last E, or Go Steward or Magma, or there are 7 at this moment, where you could perhaps log in to a website on your phone at lunch and buy, $500 worth of farmland. That's the long-term concept. None of them are quite there yet. Accredited investing and Reg D and so on do still impact that. But I don't think that those are going to be what set the marginal values of land. Those tend to be assets that are located ahead of time, appraised with some relationship to the value you would expect for a different form of liquidation or sale, and then offered in smaller shares. There is a bit of a tokenization pressure as well for assets from folks who are, coming out of this last year with large commercial real estate interests. And again, farmland, this ties to another question that said receiving inquiries from sectors and groups that we haven't before. Here's one of them. Folks who are figuring out if there's a way of moving out of commercial real estate into farmland. Folks who have, even things like opportunity funds or 1031 from other sources. But we're also getting tons of inquiries from folks who want to tie it to some other decision. So can we buy farmland, capture some other form of eventual carbon credit if we move, decisions or practices now? And again, still seeing that the questions that are rolling in are A lot of inbound calls from non-traditional sources. I'm kind of trying to say that without mentioning any names. Traditional investing groups that never had any farmland in their portfolio kind of have discovered that the last year, the correlation with farmland has been, negative or zero. That there's been very little variation in the return to farmland through time, and that looks really attractive if you have a fixed, think of a pension fund that has a future long-dated, fairly fixed obligation. So the interest in that sector has increased. NACREF, which is the National Council of Real Estate Investment Fiduciaries, has a farmland and a timberland index. The number of folks that have been, I guess, interested in becoming either contributing members or participants in that data system has grown dramatically. I think of the Chicago crowd as being a little bit more active than the New York or San Francisco crowd in this regard. But then the ag tech wants to, I would say, generally finds it to be an advantage to also tie to farm level transactional decisions.
So this is a question for Luke, and we've had this before. The specific question was that we're looking at a rent rent offer of $320 per acre for land for this coming year. And Luke, what do you think about that? And I would just mention that there still are aggressive people out there.
Yeah, I mean that number doesn't surprise me at all, to be quite honest with you. And maybe my answer would change slightly if I knew exactly the area, but here, Region 7, I know that number doesn't surprise me at all. There are definitely still pockets of really, really competitive areas. And like I said during the presentation, sometimes you can even find those within a county, let alone a region. So 320 doesn't surprise me.
All right. So we have another question, and Luke can answer this, or anybody can answer this because this is but what do you think that the future of these unscheduled payments would be? Is this because of an election year? And that's the $24,000 question. The election year, I would estimate, causes the likelihood of payments to go up. This year we saw those payments in MFP for the last 2 years as well. So, Bruce,
Luke, I'll go first on this. I think that some degree of federal support for the agricultural sector can be expected for a really long period of time into the future. And the worse the income is, the higher the likely is for some payment. But I agree with Gary that the fact that we're in an election year and the fact that we have a lot of news related to federal activities that may have impacted trade conditions increase the likelihood of that occurring. And I don't see that it's likely to go back to zero no matter what happens. Elections are very impactful, but if you look backwards in time, I think I've said this before, the party in charge of the presidency is probably not the best indicator you can come up with to find out how much federal support would come toward agriculture. I think the congruence between the parties in the House and Senate has a lot to do with it in certain years as well.
Luke, any thoughts?
No, other than I appreciate you guys taking the political question first. But no, I think it's not the only reason we saw it, but like you two gentlemen said, it certainly didn't hurt. It certainly didn't hurt. But we've seen pretty substantial or effective payments the last 2 years. So it played a role, but it probably wasn't the only role, I guess is how I would answer that.
One final item on that. Carl Zuloff, who's a policy person at Ohio State, believes that ad hoc payments are a signal of change to the federal farm safety net, and he would point to the late 1990s and early 2000s. So we will wait and see. Our sample lease is available on FarmDoc, and yes, they are, and we will link those into the description. Here's another question. All right. And what would be a reasonable potential impact on cash flows due to trading carbon credits in the near future? If they hadn't putting reasonable in there, that would be a fairly easy question to answer. So what's a reasonable potential impact due to carbon credits. Everybody's silent here. Luke, it's yours, Luke. So,
Yeah, this is where I pretend I don't have a good reception on my phone. So no, that's very hard, very hard question to answer, and I'm afraid I honestly probably don't even have a good one for it.
I'll provide a different form of a non-answer as well. Thank you. The folks who are trying to come up with the standards to credibly measure and verify. So Leading Harvest, I'm on that board, so full disclaimer, but I think they've done a wonderful job of trying to set aside the differences in how you get there and just measure outcomes. There are other groups who have come up with definitions of, organic matter in soil and how you could verify it and begin to offer that into the carbon or some form of an offset market. And I think the positive part of this is that people are more broadly beginning to understand that one of the only major places you can store carbon is in organic matter in soil. Just other efforts turn out to be rounding error compared to the impact in the teratons of carbon that you can actually put in the ground. There are lots of companies who have begun to put that into their platform as well, and you can find them with simple web searches. But I don't think we have found, we're at stage one. We haven't even put the bait on the mousetrap yet, so we can't talk about the second mouse getting the cheese here yet, because we don't have a definition that's agreed to, standardizable, and verifiable for the amount of carbon in the ground. Again, there are some companies, and I won't mention them by name. Some have been in the news a lot in the last couple of days, in fact. But if figuring out how stable the carbon is that you put in the ground is a second level of that. And then finding out whether it's a demand because it was a company that is, said in their ESG statements that we're going to be carbon neutral, or whether it's a company that does have a required legal offset for some, agreed to pollution metric, also impacts how that money is going to flow to the farm sector. But I'm reasonably positive in the long run. I don't know how long that will be. I don't know if near future is measured in epochs or years, that agriculture will be really a positive beneficiary of the continuing awareness of carbon footprint questions in other sectors.
So I would just add that I don't think it's going to go away. So
certainly not.
So what would your data set say about the difference in rental rates and land values for organic farms? And our data set does not say anything. Luke, do you have any experience with organic operations?
I have very limited experience. However, I will say that just today, actually, I'll even give credit where credit's due. Dave Klein, who a lot of us are familiar with, he and I had some correspondence, and I think that's perhaps something that we can explore in future surveys. And I think, as that topic gets a little more traction, I think that's something that, in the future we can start looking at more closely. In my specific area here, West Central Illinois, there is organic farming, but not enough, at least for me personally, to weigh a firm answer on that. But I think it's something that we can and should start looking into more closely and kind of track the trends.
USDA does do a couple of minor surveys and you're exactly right, Luke. It's just starting to get enough traction that everybody's going to do it. A couple of other, what I would think of as industry, somewhat positional papers, folks who might be either promoting one or the other, but have had to go through surveys of the impact on cash rent. Those are starting to pop up. So we should, within the next couple of years, have a better response to that.
So there's a question: general price in effect of land values of wind farms nearby or on your farm. So nearby and on your farm, any, Bruce, I would say that if it's nearby, it's probably not going to have impact on your farm at this point in time. And if it's on your farm, it'll get discounted into the price.
We talked about this a little bit last time, and I think we called out Dave Klein on this one as well, that it seems like the discount rate you apply to the wind energy payments is rather high relative to the discount rate you apply to farm level income. It's all over the place. And in addition to wind towers, solar is easier to put up and take down. As we've noted, solar seems to be in certain areas becoming more competitive. You can move them toward grids more easily because, wind happens where wind happens, but sun is a little bit more everywhere. I think that, again, going forward, we are at what long history will view as early innings in the renewable game. And people don't like wind towers on their farm or in their neighborhood, but they do generate payments that have value.
So does the prospect of Trump's defeat in the 2020 election play into your projections on future CFAP and MFP payments? My answer, and everyone will have a different opinion, is that, and we don't know what the respondents to the survey took into consideration when they gave their answer. I would say it's not obvious what a Trump election or defeat would do. I have a number of people say that if Trump gets elected, he has no incentive to provide payments, but he has in the past, obviously. If he gets defeated, well, I've heard thoughts that the Democrats wouldn't provide payments because farmers didn't vote for Democrats overall, and you could make arguments on the other side. So I don't personally think that the election has much bearing on whether you believe that MFPs or CFAPs continue after the election. I
think the power of the Senate and the Senate staying Republican may have more to do with that than the presidency, actually.
What will the Green New Deal do to ethanol, biodiesel, land values, prices, etc.?
And it says they prefer Luke to answer this directly.
What's funny is for whatever reason, I can't see the question. So could you repeat that for me?
What will the Green New Deal do to ethanol, biodiesel, land values and prices, etc.?
Yeah, stay tuned. Stay tuned.
Yeah, we don't know what that would do. I would guess that if you saw a Democrat control, you would expect to see more green sort of payments moving into the future. So that carbon credit might become more important if we saw Democrat administration and a Democrat controlled Congress. So, but stay tuned. All right, here's the questions. We recently received an offer for an easement for a power line that offered $12 per linear foot. How did this compare to recent deals in surrounding states? We don't know. I don't know, Luke, if you have any.
No, unfortunately, as far as our focus is here in Illinois, so I'm not sure how neighboring states have been compensated for similar projects.
So we also got this question. Are you seeing any changes in how lenders are calculating the value of farmland when issuing operating loans during the next year? No, we are not seeing any change in value. I would note that Farm Credit in particular uses pretty conservative land values on its balance sheet, and I don't see that changing at all. Is there any new threat related to trade war that we should consider in our business? Related to trade war that we should consider in our business models?
Well, that's a giant question, of course, and I think you have to divide the trade issues into those that are economy-wide and those that are going to impact agriculture different from the rest of the economy. And the strength of the dollar, of course, really is a complicated thing to forecast, but that may have more to do with 1 year's demand than the long-term trade war. I do think that the trade war it's important to remember that that's not something you can start or end either by yourself or at a point in time. After we normalize trade, we will have rerouted so many other things that it's going to take a while for the new, capillaries to grow and the new vessels to emerge from that. And again, we have a question that points to the item that Kelly James and others in Mercaris put together. That was kind of what I was trying to refer to without saying names about the organic land question. It's a fairly limited survey. Nice to have a collection of actual respondents, though. And then there are some other groups that are beginning to put together the same sort of thing. A couple of companies like Pipeline Foods that have a fairly large group of organic customers who have good data too. Mercaris, for those of you who don't know, if you search for them, you'll find it's a price, location, and it's a nice service targeting organics, and you should use that as a place to find some information as well. But there are lots of sources beginning to surface around that.
So we have come to the top of the hour, and got another big question here, which we'll take this one question. To keep it short, Bruce, will the Federal Reserve significantly expansion of their balance sheet correspond to increase in the U.S. money supply, lead to the strengthening of the dollar?
Or a decline, more likely.
Yeah.
So,
I can't read that.
Yeah. We have sort of a mixed technology here for reading our questions right now. The Fed's significant expansion of balance sheet should be thought of a little bit separately from the statements about accommodating or allowing inflation as well. It's a great question, one that I think, could only come from a former grad student, I see. So it's a big question. I don't think that we're going to get a massive drop in the value of the dollar that's commensurate with just the U.S. only side of the expansion of the money supply. And it's going to take a while to figure out what the gap in production was from our, set aside of economic activity during the coronavirus, and whether the, borrowing future money to plug that gap now in the form of the expansion of the money supply was an overshoot or not. And that will determine some fraction of the inflation and hence the corresponding change in the value of the dollar.
So we appreciate your time. Luke, when is our land values conference scheduled to be? Illinois Society?
Yeah, Thursday, March 18th, 2021. So I'm glass half full. We're going to plan on being there and seeing you guys in person.
Yep, when the COVID-19 will all be over by then, right?
Yep, guaranteed.
Won the election by then.
Yeah, hopefully we'll win. We appreciate your time. We want to thank the Illinois Society for working with the University of Illinois. And by the way, the University of Illinois, the Illinois Society of Professional Farm Managers and Rural Appraisers were founded here in Mumford Hall. So we appreciate the relationship, and we're proud of our heritage, and we thank Luke for heading up this effort, and we will see you all down the way.